So have you ever watched a market just break? I'm not talking about a slow decline, but a sudden, violent collapse that leaves everyone just staring at their screens asking, what just happened? Well, we basically just saw it happen in the silver market. So let's break down this absolutely wild ride.
And that's really the big question, right? How can a major global asset just go into total free fall, losing 13% of its value in the time it takes to watch a movie? I mean, this wasn't your normal up and down day. This was a shock to the system, a flash crash that vaporized weeks of gains in a single morning.
And to put a number on it, we're talking a plunge of over $15 an ounce. That is a staggering drop in just a few short hours. The speed of it was just breathtaking. So how in the world did this happen? And maybe more importantly, why?
All right, to get to the bottom of this mystery, we got to start with the event itself. Let's piece together this 4-hour meltdown, a crash that caught even the most seasoned traders completely flat-footed.
Okay, and here's the absolute key. This crash wasn't driven by some big, sudden change in what silver is actually worth. It's not like they suddenly found a mountain of silver somewhere or a factory shut down. No, this was all about the market's internal plumbing, the mechanics just breaking down. It was a mechanical, almost robotic cascade of forced selling.
So to really get what happened, you need to know who was hitting the sell button. And there were basically 3 groups of people. First up, you had the panicked. These are the momentum traders who kind of showed up late to the party and were the very first to run for the exit. Then, and this is where the real damage came from, you had the forced sellers. These were leveraged funds getting hit with automatic margin calls. Basically, the computer telling them they needed more cash right now, forcing them to sell no matter what the price was. But while all this chaos was happening, there was a third group, the strategic physical buyers, just quietly stepping in and scooping it all up.
All right, let's get to our first big clue in this whole mystery. It's this fundamental conflict at the heart of silver. It's a metal that basically has 2 faces, and it's constantly being pulled in opposite directions. This dual identity is totally key to understanding why it's so volatile.
And this slide just lays it out perfectly. On one hand, you know the story. It's a precious metal, a store of value, a hedge against inflation. People call it poor man's gold. That's the investment side. But on the other hand, it's a supercritical industrial metal, essential for stuff we're building right now. Solar panels, electric vehicles, and all the electronics that power our AI infrastructure.
And that's really the heart of the problem, isn't it? The money flowing in from investors, it's speculative, it's fast-moving, it can disappear in a heartbeat based on a headline or a change in sentiment. But the demand from factories building solar panels, that's long-term. It's structural. It's not going anywhere overnight. This constant tug of war is the very foundation of silver's famous, or infamous, volatility. Okay, on to clue number 2. We're going to pop the hood on the market mechanics, the hidden machinery that can take a tiny little tremor and amplify it into a massive earthquake. This is the volatility machine itself.
Now this is fascinating because it shows you the domino effect. So it kicks off with a trigger, some geopolitical news spooks the big industrial players, then the momentum guys see the price dip and they jump on the selling train. And that selling triggers a tripwire. All these automated stop-loss orders just start firing off, creating this waterfall of selling. And then you get the real gasoline on the fire, margin calls. Leveraged funds are forced to sell, period. They don't care about the price, they just have to get out. And that's how you get a death spiral.
But you know what? This kind of leverage-fueled chaos is not a new story, not by a long shot. Way back in 1980, the famous jewelry company Tiffany & Company actually took out a full-page ad in the New York Times to condemn what they saw as just blatant market manipulation.
And this chart shows you exactly why they were so mad. This is the infamous 1980 price spike when 2 Texas oil heirs, the Hunt brothers, used a crazy amount of leverage to try and corner the entire silver market. They drove the price into the stratosphere before it all came crashing down spectacularly. It's just this perfect historical lesson in how leverage can completely warp this market.
Okay, so let's move on to our third and final clue, and this one is huge. To really get silver, you have to put it side by side with its bigger, much more stable sibling, gold. This comparison tells you everything you need to know about what makes silver so unique.
Wow, I mean, this visual just says it all, doesn't it? The entire silver market, all the investments, all the speculation, the whole shebang is just a tiny fraction of the gold market. According to Goldman Sachs, it's about 9 times smaller. And that's not just a fun fact, it's absolutely crucial.
So why does that matter so much? Well, a smaller market means way more volatility. Think about it. It just takes a lot less money to make big waves. A huge fund moving cash in or out of silver is like dropping a boulder in a pond. Doing the same thing in the massive ocean of the gold market, it barely makes a ripple.
So when you boil it all down, silver is just structurally riskier than gold for a few really specific reasons. For starters, unlike gold, central banks aren't buying it up for their reserves. There's no big, steady buyer propping up the price. Then there's the industrial side, which ties it to the ups and downs of the economy. And it's simply less liquid, which is like an amplifier for price moves, both up and down.
And this chart of the gold-silver ratio, it tells the story perfectly. For years, they kind of moved together in a predictable dance. But just look at what happens after 2022. Gold takes off, it decouples, fueled by massive buying from central banks. And silver? Well, without that official support, it gets left in the dust. It really shows you how much it depends on those more, let's say, fickle private investors.
Okay, so we've looked at the crash, we've looked at silver's split personality and its relationship with gold, so now what? Let's put all the clues together and try to figure out, where does silver go from here?
Well, as you can probably guess, the experts are all over the place on this. On one side, you've got Citigroup, who are super bullish. They're calling it gold on steroids and talking about a potential run to $150 an ounce, driven by supply deficits and investment flows. And then on the other side, you have strategists like Marko Kolanovic basically saying, not so fast. He's warning that it's a speculative bubble that could pop and lead to a 50% drop.
So you've got the bulls and the bears locked in this epic tug of war. What's the one thing that pretty much everyone can agree on? It's that this volatility, it isn't going anywhere. These huge sharp swings aren't a mistake or a bug in the silver market, they're a feature. It's the only constant you can actually bet on.
Which really leaves us with one last big question to think about. In a world that just feels more and more uncertain every day, is all this crazy volatility in silver a fundamental flaw? You know, a bug you should run away from? Or is it actually a feature? Maybe it's just the perfect amplified expression of the risks and opportunities that define the world we live in now. That's something to chew on.